The importance of defining your trading edge. Find your strategy. A trading edge is a technique, observation, or approach that creates a cash advantage over other market players. It doesn't have to be elaborate to fulfill its purpose. Anything that adds a few points to the winning side of an equation builds an edge that lasts a lifetime. Don't be frustrated if you haven't found one yet because the majority of traders don't even know it exists. It's the primary reason why a few book excellent profits while everyone else struggles with weak or negative returns. There are many ways to build trading edges, but we'll focus on the one approach that capitalizes on the technical skills you've already learned. It's a simple process that takes an established strategy and adds detailed rules to filter out the majority of potential candidates, focusing your attention squarely on the most promising opportunities. It then introduces a second rule set to your trade management, seeking the biggest profit from each winning position. Edgeless Strategies. A quick reality check will tell you if your trading strategy has a definable edge. List the most common methods you use to find new opportunities, entry and exit positions, and manage risk. Then try to remember where you learned those specific concepts, whether from a book, website, or another trader. Finally, consider how many other market participants are playing the exact same strategies, often at the exact same time. Through this self-reflection, most traders will quickly realize they're becoming lemons, opening positions and managing risk using the same strategy as the majority of market players. There are two reasons why it's impossible to book reliable profits when you're part of this crowd. Firstly, you're competing with all those people for the same pot of gold. Secondly, crowds attract unwanted attention from other traders who notice the liquidity pool and execute predatory strategies to shake out weak hands. The sheer number of participants acting the same way eliminates the edge that made those strategies work in the first place. But that doesn't mean you need to abandon the trading and technical analysis skills you've taken so long to learn and master. In fact, edgeless strategies popularized in books and websites work really well as building blocks for more powerful techniques that will retain their edges through a lifetime. Temporal edges. Market changes all the time, creating and destroying trading edges that tap into the complexities of the current cycle. The trick with these temporal edges is to work them aggressively until the crowd shows up and then back off, utilizing them only when other folks are leaning the wrong way. Buy the dip strategies, which were very popular at the turn of the millennium and after 2008 crash, and classic temporal edges that failed miserably in more challenging market conditions unless specialized rules are applied. Regulations and technologies also give way to temporal edges with the rise of high-frequency trading, HFT, as a strong example. Prior generations enjoyed similar edges with bullet trading and level 2 scalping. System traders have an advantage over the discretionary traders with these heavily technical strategies, but destroy their edges by over-reliance on back-test results that fail to account for the market's dynamicism. Creating your own edge. Like edgeless concepts found in books and websites, temporal edges provide a foundation for more powerful strategies. To show how this works, we'll take the buy the dip strategies and apply special rules that identify entry prices when the crowd is unlikely to join us. It's easy to get shaken out if we enter too early, so our primary task is to identify narrow levels where the reversal odds are so great we can utilize tight stops with confidence. Then if we can replicate the results across multiple securities in the divergent markets, we've overcome the temporal disadvantage and identified a trading edge that may last a lifetime. We'll apply the concept of cross verification to our buy the dip scenario, looking for as many technical reasons as possible that our security will turn a narrow price level. The more cross verification points we cover, the higher the odds the level will act as an intended in stopping a declining and triggering a bounce. We'll pass on the opportunity if we can't find at least 4 cross verification points. Finally, we'll apply opportunistic management rules to book the biggest profits, which usually mean taking advantage of the crowd after they see the bounce and jump mindlessly. iShare Dow Jones U.S. Real Estate Index ETFR IYE broke out of a 3-month cup and handle pattern in November, also completing a long-term breakout. The rally started a 6-year high near 78 and settled into a rectangular pattern above new support. The fund broke down nearly 3 weeks later, penetrating new support but not breaking and providing the first verification point for our strategy. The November 21st breakout gap red circle filled up, landing price on support at the 50-day EMA, adding second and third cross verification points. That level also marks the 0.786 retracement of the breakout swing, adding a fourth point, while stochastic plunges into deeply oversold levels, marking a fifth clue that the recovery will begin 75 and 75.50. Finally, the decline settles near the 60-minute 200-bar EMA, classic turning point for pullbacks in uptrends. Price structure and seasonality raise odds even further for our specialized dip trade. The crowd missing the breakout entered position within the rectangle, which were subsequently targeted in the breakdown, but were executing a strategy that benefits from their pain, providing us with a lower entry price. And since they're selling where we're buying, it's less likely we get targeted by predators. Seasonality comes into play because the breakdown happens during options expiration, dropping the fund into the popular 75 strike, forcing the pool of open interest into worthless positions. Now we apply our edge to finding a fruitful exit, hopefully using the crowd to our advantage once again. Two potential exit points appear, one at the prior high near 79 and a second the rising high trend line near 80. Exiting into prior high offers the safest route because it's a location where sellers could trigger another reversal. Our tape reading skills now come into play because the price settles into a bullish 60-minute consolidation that lasts 8 hours, black rectangle on a 60-minute chart. The lack of selling pressure emboldens us to play for the higher exit, which has 3 advantages. First, it will hit an 80, a natural open interest target during expiration. Second, it will push out top of the Bollinger Band, setting off a common sell signal. Third, it will reach resistance after a small-scale breakout and encourages a new crowd to take risk. We ride their greed into magic number, taking a sizable profit with predators line up to feed on the newly minted bulls. The bottom line, a trading edge defines your technical or strategic advantage in a highly competitive market environment. Traders can establish multiple edges by starting with popular strategies and customizing rules to lower the risk of getting trapped with the emotional crowd. You know the catchphrase. Study it, analyze it, adapt it. Peace.